How does payroll remittance frequency work for foreign employers? Once a US company registers for Canadian payroll, one of the first questions is how often it has to send in the deductions it withholds. In other words, what is your remittance frequency? It is not the same for everyone. The tax authority assigns employers to categories based on the size and behavior of their payroll, and those categories determine how quickly you must send in income tax, pension, and employment insurance amounts after each pay. For foreign employers, the rules are essentially the same as for domestic ones. You are not given extra time just because your head office is across the border. The system cares about how much you withhold and how reliably you remit, not about your postal code. How employers are grouped for remittance purposes. Every employer with a payroll account falls into a remitter group. New or smaller employers usually start in a basic category with a monthly deadline, while larger or historically late remitters can be moved into more frequent schedules. The idea is straightforward. The more money you are holding in trust for the government between payday and remittance day, the more quickly they want you to send it in. When you first register, you provide an estimate of your payroll, and that estimate helps the authority assign an initial remitter type. Over time, your actual average withholding and your payment history can move you into different categories. Monthly remitters and the starting point. Many foreign employers begin as monthly remitters. That means you calculate deductions from each pay throughout the month and then send a single combined payment by a set deadline in the following month. For a small team, this is manageable. You run payroll on your chosen schedule, track the total amounts withheld and owed, and then make one payment covering all pay runs in the period. While monthly remittance feels comfortable, it is important to treat the withheld amounts as trust funds, not temporary cash flow padding. From the moment you take money off an employee's gross pay, Canada expects you are holding it on their behalf, not using it to smooth your own short-term liquidity. Accelerated remitters and increased frequency. As payroll grows, employers can be reclassified as accelerated remitters. That is where remittances move closer to the pay date, sometimes within days. These categories are triggered by higher average withholding amounts and are designed to reduce the time between when employees see deductions on their pay stub and when those sums reach the government. Foreign employers are treated like any others for this reclassification. If you cross the relevant payroll thresholds, you can expect to be notified that your remittance schedule is changing. At that point, it becomes even more important that your payroll cycle and your cash management routines are synced, because you no longer have the luxury of waiting until the next month to remit. How history and compliance affect remittance frequency. Remittance frequency is not just about size, it is also about behavior. Consistent on-time payments keep you in the category you deserve based on payroll levels. Late or missed remittances can trigger penalties and can, in some circumstances, lead to closer monitoring. For a foreign employer juggling multiple jurisdictions, it is easy to let Canadian remittances slide down the priority list. That is a mistake. Late remittances are treated seriously, and the amounts involved are often small enough that there is no good business justification for risking penalties and reputational damage. Integrating remittance schedules with your payroll system. Practically, your remittance frequency determines how you structure internal processes. If you remit monthly, you can align the payment with your month-end close and cash forecast routines. If you remit more frequently, you may need automated reminders, dedicated payment workflows, or direct integration between your payroll system and your banking platform. For US companies, the key is not to treat Canadian remittances as an afterthought. They should have owners, calendar entries, and explicit sign-off steps, just like any other recurring obligation. That way, changes in remitter status become adjustments to an established process, not last-minute scrambles. What happens if you miss a deadline? When an employer misses a remittance deadline, interest and penalties can apply. The fact that the employee ultimately pays the right amount of tax on their return does not erase the employer's duty to remit on time. For foreign employers, these penalties can be especially irritating because they usually stem from simple inattention rather than from any real financial pressure. In more extreme cases, repeated non-compliance can lead to more intrusive enforcement or a loss of trust in your reporting. That is the last thing you want when you are already learning a foreign system. Final thoughts? Payroll remittance frequency for foreign employers in Canada depends on the size and history of your payroll, not your country of origin. New and smaller operations often start as monthly remitters, while larger employers move into accelerated schedules as withholding amounts grow. In every case, the core expectation is the same. You withhold when you pay, and you remit on time according to the schedule assigned. If your company is stepping into Canadian payroll for the first time, treating remittance deadlines as part of your core finance calendar is one of the simplest ways to stay on the right side of the rules. For more practical checklists and examples, you can explore www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.